and welcome to Unlock the Stock. We are pleased to welcome Astoria back to the platform. This Unlock the Stock platform is specifically designed for retail investors to gain access to corporate management and get to know both them and their companies better. Jan van Niekerk and Piet Viljoen, non-executive directors of Astoria, will take you through your presentation shortly. Unlock the Stock is only possible with our technology partner, RECM Global. Please visit their website, lumieglobal.com, to learn more about Lumi's various online AGM and investor presentation solutions. Our host today will be Mark Tobin, and he will be facilitating the Q&A session. Before we start, a few housekeeping notes. Jan and Piet will take you through a presentation followed by Q&A, and please note that you can post questions by typing them into the Q&A box at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel. You will see an email address when we begin the Q&A, and if you'd like to be added to Astoria's distribution list, please send an email to this address. Jan, can you please share your screen and take us through your presentation?
That's it. We're good to go.
Thanks, Maurice. Thank you, and good day, everyone, and welcome to a rundown of what's happening at Astoria, an update on what's happening at Astoria. So if we can have a look at basically where we've come from. So the history is that Astoria is a Mauritian-domiciled investment holding company. It's listed on both the Stock Exchange of Mauritius and the JSE. And since December 2020, it has been managed by RECM Global, which is a Mauritian-domiciled management company. So RECM Global's aim in managing the assets of Astoria is to grow the net asset value per share at a high real rate over time. And importantly, we measure our progress in US dollar terms, so hard currency terms. We want to generate a high real rate of return in US dollar terms, despite our network being situated in South Africa. We think South African assets are priced to generate good dollar-based returns, and we also think our network is strong to provide us access with good assets in South Africa. So the mandate of Astoria is very flexible. We can invest in anything, anywhere in the world, but we prefer to focus in South Africa because that's where our network sits, and that's where we think assets are priced very attractively in general. You can see the progress we have made since we took over management in December 2020. If you index it at 100 at that time, in dollar terms, we've gone from 40 US cents, 40.1 US cents to just shy of 80 US cents, which translates into a compound annual growth rate of 38.9%, and in rands we've grown at 51.5% over that 3-year period. So we move on to the next slide. We can just tell you a bit about how we think about investing. Very importantly, we like to invest with founders or entrepreneurs. We're a global investment company that partners with teams of entrepreneurs, predominantly South African business, but also offshore ones as well. Our existing portfolio of companies all have defendable moats, either in the form of licenses, brands, and possibly even scale. And any future acquisition we'll make, we would want them to have some kind of moat which enables them to generate high returns on capital over time. The fact that these businesses can generate high returns on capital is a feature, and that means they can also reinvest their profits at high returns, as all our companies have been doing over the past few years. And finally, as the management of Astoria, we heavily invested in the shares of Astoria. We own a large proportion of the business, and the management of our underlying companies also are heavily invested in their businesses as well. So everybody is aligned with a goal of growing the net asset value per share of Astoria at high US dollar-based returns over time. The portfolio currently, as it stands currently, and this is a moving feast. As we make acquisitions, or as our underlying companies make acquisitions, this can change over time. At the moment, Outdoor Investment Holdings is just under 50% of the net asset value. Outdoor Investment Holdings, as you might know, is a holding company of, amongst others, Safari Outdoor, some distribution companies, Family Pet Center, and a couple of other businesses. The second biggest exposure we have is to the diamond mining business via Transx land operations and Transx marine diamond operations. That makes up almost a quarter of the net asset value. Then via Rech preference shares, we own 8.3% of Gold Rush, one of the large alternative gaming businesses in South Africa. Isaac Carstens is of a similar size of the NAV, just over 8% of the NAV. We own a 49% share of that business. That is a health and beauty training college in Stellenbosch and Pretoria. Vehicle Care Group makes up 6.5% of the net asset value per share, and that is a car financing business, predominantly a car financing business. Liat Corporation makes up 3%. It's still quite small, but there have been some events post year end, which Jan will cover. And then Astoria Treasury, where we make loans and manage our cash, is 1% of asset under management. So if you have to sum up Astoria in a nutshell, we think relationships matter. We try and implement win-win investment strategies with the business we invest in, and we do that by being long-term partners. We are not managing these businesses. They've got their own very good management teams in place. We are the partners of those management teams, and we think that leads to a win-win investment strategy where relationships are key. So with that, I'll hand you over to Jan, who can take you through each one of our investee businesses.
Thanks, Piet, and thank you very much for your time, everybody. You'll see the heading of the previous slide spoke of value creation versus value investing. We've said this before, but I think it is important to mention that we have come to understand and learn that value investing, as most people know, it is something that you practice on listed investments on the stock exchange. If you try to do that in private transactions, I think we have found we fail on that. We'd rather not do a sharp deal, but rather be a very good partner to people that run good businesses for a long period of time. And you'll see that feature through that. So the single largest asset is Outdoor Investment Holdings. As Peter said, in there we've got Safari and Outdoor, which is a outdoor retailer, 5 mega stores and 1 smaller store. We also own Inyati and Formalita, which are 2 wholesale distributors in South Africa. And in the last few years, we've acquired a 1/3 shareholding in a manufacturing business called AltX. AltX manufactures equipment, mostly muzzle suppressors for hunters and for hunting rifles. And then we also own the Family Pet Center, which is a chain of mega pet centers. So, big stores, because that's the model of the business here. During the last year, what we have seen is strong growth in both the retail side, so that's Safari and Outdoor, and also our wholesale distributors in Yati and Formalito in South Africa. This business is very much a relationship business with your suppliers. Many of the brands are owned by families in various parts of the world, and they rely heavily on long relationships to have stock available. And in here, the crux is having access to stock. Every time we've been able to increase our stock levels in the business, that's come with increase in sales. And last year was not an exception. So we've had turnover was up about 13 or about 11%, which translated to EBIT 13%. And that's after the previous year. That was a very strong year already in 2022. The parts of this group that was slightly disappointing was AltX. Their sales were flat. They had manufactured quite a lot of stock, but it hasn't sold yet by the end of the year. We're learning that that's part of the nature of a manufacturing business that is quite cyclical. And then the Family Pet Center, we haven't grown, we haven't opened new stores. We focused on other areas of the business. It's become quite a decent size of the business, but because the core of Outdoor Investment Holdings have grown so quickly, Family Pet Center has become a smallish part of the overall group. The way we value OIH is we value the South African leg of the business on 6 times 12-month EBIT. This company has a February year end, and we need to provide valuations in December, so that's why we use a 12-month EBIT. AltX, which is Norwegian based, so there's obviously much lower cost of capital. That business we value on an 8 times rolling EBIT number, and then we make the adjustments to the balance sheet. So if you put all this together, plus the dividends we received from OIH in the last year, then it grew by about 16 and a bit% for the whole year, or the value of our investment, and it has now become the single largest asset in the group. growth opportunities here. Every year we think that we've hit the level, and then Marco van Niekerk and the management team pulls a rabbit out of the hat, and they manage to grow sales even further. We really think there's no more place for big stores or mega stores like we have in South Africa at the moment. We've proven the concept of the smaller stores, so there's an opportunity to roll out some of the smaller stores. Obviously, the wholesalers can still grow. And then, if we can't grow trading densities, the nice part of the way that Astoria is set up is management can send cash back via dividends, and we can redeploy that in the group. But we're very confident that this team here understands return on capital. They understand the link between an income statement and a balance sheet, and they respect the owners of capital the same way we do. So this is a very good relationship for us, and we receive our dividends, and for the rest we will help with some guidance. The second largest economic grouping of investments in Astoria is our diamond mining operations. So we're invested in the old Transhex, which is a land-based business, which these days mostly have a 1/3 shareholding in Sumulawana, which is a mine in Angola. And they still have some land in the Northern Cape and so on, but most of the value resides in Angola. And then in August 2022, we acquired a 25% share in various companies, which together forms the marine diamond operations. So last year, I think it's quite fair knowledge that diamond prices were under severe pressure, and we've been discussing it internally. The reasons put forward is, a weaker world economy, growing of lab-grown diamonds, of interest in lab-grown diamonds. We do know that some Russian diamonds are finding their way into the market, etc. So that's all meant that diamond prices across sizes and grades have basically come down by 1/3 or more over that period. And what's quite pleasing is that both these businesses, the land-based diamond, alluvial diamond operations, and the marine diamond business, was profitable. Not spectacularly profitable, but if you look at most commodity companies, if you have a 1/3 or more drop in the commodity price, many of these go into losses. So the businesses did remain profitable. So obviously, in the back of that, we haven't repatriated any cash or dividends or from Angola. And then on the marine diamond side, we have revalued that business for the first time since we acquired it. What it meant is, and it shows that the price we paid for the business was a very good price, that even taking into account lower diamond prices and the lack of significant profits for the year, the value of that business on an NPV basis is still 42% higher than what we paid for the business in September 2022. We've also learned that the marine diamond business is a better quality business, because remember, in Angola you have a hole in the ground where you mine diamonds, and then those diamonds need to be sold. The cash needs to go back to Angola. You need to pay for capex and growth capex, and then the management there have to spend a lot of time to repatriate the dollars back to South Africa before it becomes valuable in the hands of the company here. So that's why you'll see we value Transhex, the land-based business, we value at a 32% discount to its net asset value. And that basically reflects the risks involved in the geography and the currency and the lack of the ability to get money out as and when we want. Whereas the marine diamond business mostly consists of 4 very large vessels. 3 of them are either survey or mining plants, floating mining plants, and then 1 is sort of transports fuel. But they can literally go anywhere in the world. These mines can operate on our own concessions and our own licenses and land. But if you run out of mining operations there, you can go and mine on someone else's concession and still make money from that. So the asset has a different value characteristic to it. When we sell those diamonds, the money comes straight into our own bank account or into marine Transhex Marine's bank account. So there's no issues with moving money around. So we think it's more stable, and we've seen that the production is much more stable, and it's easier to get your hands on the cash. So we think the transaction of having acquired the marine diamond business was a great addition to the marine diamond or to the diamond mining area in Astoria. Now, subsequent to year-end, in order to grow this business, and most of the money will be used to improve the efficiency of the ships and to conduct maintenance, this whole grouping have raised $17.5 million through a rights issue. The rights issue price was at the same price at where we have valued our interest in the various companies, and Astoria did not follow its rights here, basically because we don't have any cash in the company. I think if we had cash reserves at the center of Astoria, we would have loved to follow our rights there, Piet, and we can talk about that later. But Astoria's policy at the moment is we are fully invested. The capital of the company is deployed in the underlying companies and stock and debtors and operations. So we don't run Astoria with a significant cash at the center. So we didn't take part in that rights issue. That means Astoria's interest in the various diamond companies have reduced to about 14% going forward.
Backwards.
After the diamond operations, the next largest investment is basically Gold Rush, which is South Africa's largest alternative gaming operator. Gold Rush is owned by RECM and Calibre, which is listed on its own. So Astoria owns about 15.1% of the economic interest in Rech. It owns a bit more of the preference shares, but Rech also have ordinary shares. So on a look-through basis, Astoria owns about 15.1% of Rech. Gold Rush reports its own results. It's a March year-end, and normally the results are out in June. The last time Gold Rush reported, or Rech reported, was in September of last year. And at that stage, the news to the market was that because of load shedding that interrupted operations and customers at the beginning of 2023, it had an impact both on the top line in terms of revenue and on the expenses, because the company had to spend some money to get its own electricity supplies up and running. What has happened subsequently is that CapEx have gone in and it's been in place. And like all management teams in South Africa, the Gold Rush management team have figured out a way to deal and to handle and to operate in this environment. What we have seen is that the online gaming part of Gold Rush have done spectacularly well, like most of the other online gaming operators in South Africa. There's a number of those that have reported publicly, and if you follow the commentary, our sense is Gold Rush have had a similar experience. Inside of Rech, Gold Rush is valued on 7 times EBITDA, and with a balance sheet adjustment. But in Astoria, we value Rech or Gold Rush at the listed share price of Rech, which traded at a discount to the calculated net asset value. Isaac Carstens, as Peter said, is a skincare and health and beauty education institution with campuses in Stellenbosch and in Pretoria. It's a business with a 45-year-old history. It's more than 4,000 alumni, ladies, mostly ladies that have studied at ISA and have left and started their own businesses and worked in many parts overseas. The focus of ISA's education is to have a student, when they leave ISA, to have all the skills and the business knowledge to be able to run their own businesses. So the focus is to make them economically active straight away so they can make a living for themselves. The two campuses have capacity of just over 600 students. So last year, the number of students increased to 579, and this year we already know that we're up to sort of 590. So we're approaching sort of full capacity on physical capacity for the schools. Obviously, the natural thing is to use technology to sweat the assets more, so we can have more students without having to open more campuses. That's the natural way to go. Because this is a very strong brand, and ISA has basically become the dominant school in that area, and the qualification is very sought after, we have been able to increase fees ahead of inflation, because like most institutions in South Africa, municipal related property and energy costs have been quite significant. So ISA has been able to protect against that, and that's the nature of a business that have pricing power and a long history. So, and we think that will remain. And then in the last year, ISA has launched their own range of skincare products, and it's basically done to tap into and work off the Isaac Carstens brand. The model there is designed to work with the 4,000 alumni, so they become part of the ecosystem of distributing and selling the product. We know that skincare products are a very different line of business for ISA. It diversifies our income stream. It's a much bigger business, and the economics of that business is quite attractive. So it improves and increases the economic value going forward. So what happened with the operating leverage is, as the student numbers grow and we're able to increase our tuition fees and we have a fixed cost base, that means that the profitability, you have the operating leverage coming through. So in the last year, the value of the business increased by 35%. Most of that increase came from an increase of the value of the school. So we value the properties and the school separately. The properties are valued on the same cap rates as market-related cap rates, let's put it that way. And then the school, we have moved, and we used to value it at a 6 price earnings, or a PE for all the time. Now that the school is full and it's proven pricing power after COVID and so on, we've increased the valuation from a 6 to a 7.5 PE, which is still a significant discount to where other listed education stocks are trading. We think it's fair to increase that valuation a bit. And then VCG is one of the businesses that we have been involved in from the startup phase. It basically does 2 things. On VCG Invest side, we provide funding to used car dealers, and it's basically working capital for them to be able to increase their stock and their floors. It's asset backed, so we take the actual vehicles as security. So there's multiple security of that. And then on top of that, we have VCG Flexi Drive, which is a business that have a fleet of vehicles that is leased out to families or individuals. Flexi Drive funds mobility, not vanity. So it's mostly a family that can't get bank funding to buy a car, but need transport to take the kids to school, to get themselves to work, etc. So the average value of a car there is sort of 200,000 Rand. And they have a long lease, so a 5-year lease, on which they rent the vehicle, and at the end of the lease they have the option to buy the car. So it's a rent to own model. The beauty there is that, which is different from a bank finance, is if the customer finds themselves in a position where they cannot afford it anymore, they bring the car back, and there's no penalty. And we can get the car and lease it out again. So both of these businesses have been startups. The loan book has stayed sort of at 105 million for the last year. It went up a bit during the year, but we've just implemented some stricter lending criteria given how difficult things are in the economy. We are always quite skeptical of credit businesses that grow quickly. It's very easy to write a check, but you have to make sure you get the money back. The leasing business has grown much faster. That's gone from 560 to about 800 vehicles, and that was 300 a year before that. So that fleet has grown. Both of these have reached profitability levels, and that means that the proof of concept is now done. We know the business works. We understand the unit economics here. The founders of the business have brought it as far as we think founders do, and we've been actively involved with the management team there to strengthen the management team, and we've hired some strong people to join and to keep growing this business. It's safe to say this is the one business where we think there's still a lot of room to grow in the South African economy. Just because it was an early stage business, it's much easier to just fund a startup business with loans rather than equity. So that's why there's this anomaly that we keep on talking about, the shareholders' loans. The equity, and because equity has some management incentives in it, we funded it through loans. During COVID, we wrote down the loan significantly, and then as the business traded out of COVID, we wrote back some of those discounts. It means the equity is still at 0, but basically shareholders' loans can be viewed as equity in the structure. Yeah. And then the last asset is Piet. It's a South African founded business with a global reach. They make protective gear for people that basically are involved in dangerous sports with wheels. So if it's motocross, downhill mountain biking, snowmobiles, and they've expanded beyond that. it started as a business that was based on safety and security for riders or participants here. And then what happened is the brand became cool, and it's getting cooler all the time. And that means that the sales reach have grown way beyond South Africa. So as of today, more than 90% of the sales of this business happens outside of South African borders. I think they're in like 40 countries around the world, and the management team, we think, have done a great job. The model here, if you want to think about something to compare it to, is a bit like Nike or Apple. The business will be successful if you have a small team of people that can design products that's functional and that clients want to buy, because that means they can charge a fee, the brand entrenches itself. The manufacturing is outsourced, a very big part of the distribution and sales is outsourced, but the team here is in control of design, on coordinating the manufacturing, and then the sales and marketing. And the safety of as Piet says, the safety of the products obviously is the main element here. I mean, the goggles that you see in the picture there is literally bulletproof. That's one of the features that they have, and it's a funky way to test it. So the Liat brand these days sits somewhere between, let's say, Under Armour and Red Bull, if you want to think about the type of brand where it's going and where it's heading. Obviously, after lockdowns, people went out and bought a lot of outdoor kit, and Liat was a big beneficiary of that. So sales increased tremendously over 21 and 22, and since then, sales have come down to more normal levels. So we have seen that. And in line with that, the share price is down 50% over the last year. We value our investment in Liat at the share price. We took advantage of that reduction in the share price. And then after year end, Astoria was able to acquire a significant stake in Liat from one of the big shareholders there. And that was done. We've been able to issue shares in Astoria at Astoria's net asset value, so not at a discount. And those shares and a bit of cash was used to buy the excess 6.25% of Liat at a price of $13.67, which was a premium to their share price at the time. But we thought it was a fair. The principle behind the transaction is what is a fair value in Astoria and what is a fair value in Liat, and that's a principle we applied there. So after this, Liat's now become, I think, the third largest asset in Astoria. So it will be Outdoor Investment Holdings, the marine assets, and then Liat will be the third largest asset there. We think this is also a business where it can grow very fast without requiring any capital. In the last year, as sales have come down, what you would expect in a business like this is that you'll trade into cash, and that's exactly what happened. The balance sheet's got more than $20 million of cash. Their stock levels have retained, so they're not sitting with old stock. They're able to sell the stock, and they've spent the year improving their team, so appointing design and marketing personnel in the business. We're quite excited about the future of what Liat can do. So if you think about all of that, how do we think about how value accretes to shareholders of Astoria over time? And basically, our philosophy is that the capital of Astoria, which is your and our money, is invested with each of these underlying businesses. And in most of those, our capital is tied up in stock and debtors at the moment. And that stock can be sold at a margin. And as long as the guys can pay the expenses and have some money left at the end of the year, what we see is those are very decent to high returns on capital. And every so often we would sit and discuss every business and with the management team and say, guys, do you have cash in here that you cannot deploy? And every time, at least for the last 4 years, the answer has been, we can put this capital to work in our business ourselves. So we're in the lucky position that we do not need to find other things to do for the capital, because these great operators can use the capital quite efficiently inside of their own businesses. So the way we make money as shareholders is by our capital being adequately and properly deployed in the underlying companies. As they grow their value, that will come out in the net asset value of Astoria. To the extent that they get cash that they can't need, that will come to the center, which we can reallocate, either invest in one of the underlying companies or we can find other investments to do. Astoria has the opportunity to buy back shares. I think we have stated publicly that that will be our last option at this stage. We are looking to grow the size of Astoria. The net asset value is basically approaching about $50 million. That is quite small for a listed company. We'd like to get the size of the business bigger. There is some benefit that come with scale. But for now, we're not faced with that problem because all the companies have very good returns on capital underlying. So as an example of some of these mechanisms, we've spoken about Astoria acquiring 6.25% of Piet post year end. That's one way in which we create value. And then I think we have also mentioned in a shareholders letter that one of our fellow shareholders on OIH had sold 2% of the company, which he owned to arm's length third party transaction at 1.2 billion valuation. We at Astoria, we had valued OIH at 950 million. So it's a decent premium to where we have valued it. So I think what it indicates is we are fairly conservative on how we value the assets, and we try to do that over time. Of course, we need to be fair to give you as a shareholder an indication of what we think the real value of the business is. But philosophically, we try to value the underlying assets in such a way that there are returns that will accrue over time. There's no benefit to us in capturing all the future value in the current valuations. We think it's fair that as the underlying businesses make the returns, that comes to shareholders over time. The last bit is, and I don't know if it's important to people or not, it's a legacy of Astoria. We still have more than 5 billion in pre-approved exchange control allocation. So to the extent that we need and want to reallocate capital into different opportunities, if it is outside of South Africa, we have pre-approval to do that. There won't be any exchange control issues around that. The last slide I want to just talk to quickly is a bit about currency, because obviously this is a Mauritian-domiciled investment company. As Piet said, we are looking to grow the net asset value per share at a decent clip in dollar terms, like an international currency. So obviously currency is something that we get asked questions and that we have to consider all the time. The graph there shows the rand-dollar exchange rate since Astoria came under RECM's management in December 2020, and despite the worst load shedding, a lot of political campaigning in the last while, it seems like the ruling party is going to lose its majority. There's evidence of infrastructure not being maintained and falling over. All the bad news you can see in the newsletter, in the newspapers. Despite that, the rand's depreciated by 21% over that period, which is about 6% a year, which is approaching sort of interest rate differentials or inflation differentials over that period. So 2023 was about 8% for the year. So we do not take hard and specific views about the currency. Our view is that if you buy good underlying assets, the value accretion in a good business is much better than what happens to the currency over time. And therefore, we don't spend a lot of time thinking about the currency and trying to trade off the currency and the assets in the portfolio. What has happened over time is that by increasing Piet and having bought the marine diamond businesses, we probably have increased the percentage which are dollar or non-rand related income streams in the business a bit. But that's a consequence of finding a good investment opportunity, not because we set up deliberately to go and look for other assets in other places. So we spend most of our time working with the management teams of the underlying companies to achieve that. If there's anything you want to add?
No, I think that's it.
Thank you, Jan and Piet. We will now go into the Q&A session. And as a reminder, please add your questions to the Q&A box at the bottom of your screen.
Thanks, Marilise. Thanks, Piet. Thanks, Jan. And thank you once again for coming back to Unlock the Stock. It's great to have you back in for an update. And I'll just pass on our apologies. The finance ghost is off haunting corporate management teams in a boardroom somewhere else today, but we will still continue on as normal. I might just throw out the first question while we're waiting for them to come through here in the chat. More of a broader question on how you, the board, is thinking about asset allocation between public and private, because there's a lot of talk in the financial media, and the current zeitgeist is, investment holding companies should be, housing more private assets that, people can't just go and buy, whether that's Liat, publicly, or, Gold Rush via, you guys have increased Liat, which is kind of more counter to kind of what's happening in the broader investment holding company space. So maybe just talk about how you view that public versus private allocation, or thoughts on it more broadly.
I think if I can kick off by saying that although we have increased our exposure to a listed asset in Liat, and we also have exposure to another listed asset in Gold Rush via Rech, both Rech and Liat are highly illiquid counters. So it's very hard to get exposure to them through the market. Liat is listed on the pink sheets in NASDAQ. It doesn't trade very much at all. And Rech also almost never trades on the Johannesburg Stock Exchange. So to get exposure to those stocks is not easy, even for retail investors. Not easy to get exposure to those stocks. So the way we look at it, being listed or unlisted is not really for us the determinant of what we're doing. We just want to be involved with good businesses, and I think that drives our decision making, not whether they're listed or not. The fact that some of our stocks are listed is by the way.
Okay. And then maybe if we can maybe continue down that vein, concentration within the portfolio on a kind of more broad level, are you, looking to have, spread across 20 different businesses that, vary up and down over time in terms of their allocation, or do you want to keep it small where you've got, 5 or 6 kind of exceptional businesses and they're all give or take 15-20% here or there? Maybe just the level of concentration that you would like to have versus to where the portfolio is now.
Okay, I think we have limited bandwidth, so that means it will be unlikely, given the way in which we run the relationships with the underlying management teams. It's unlikely for us to have 20 underlying assets. I think we have found our sweet spot on our style to be one where we can work with competent management teams and asset allocators to help them. So if you look at ORH, the first time when we invested in that company, they had 3 stores. I think we provided the money to open up the 3rd store. And subsequent to that, they have acquired at least 4 new businesses and started up a few more. So that's where we can help to grow, and we don't have to do it on the Astoria level. It's much more efficient because these are operators that understand the industry and the restrictions and they have a common understanding of capital allocation to the way we see it. So that's much more efficient, and we can deploy more capital doing it that way. We don't have any hard and fast rules in terms of how big any asset can or should be. I mean, RECM at the moment is touching on 45%, and that's just because it's done really well. And we will not sit here and try to sell a piece of the company just to get it down to 40%. That won't be the case. Obviously, we understand that diversification is a benefit to our investors, but there is a common theme to the assets that Astoria owns, and these are mostly B2C companies with a brand, under a license, or with scale. And if you look through that, that's the area that we find the sweet spot. And then obviously management teams that appreciate a partner that helps them with capital allocation. So we don't have hard and fast rules. If we can leave the existing portfolio as it is and the capital can compound over the next 10 years, that won't be a bad outcome. We really don't think that. We don't think, and we don't back ourselves to do lots of mergers and acquisition deals in Astoria to have to make money that way. I think the other point is also Astoria isn't a story investment. It's not something where we'll come to the market and tell you, yesterday we've done a new, or signed up a new client or whatever it is. The business is one where every underlying company keeps on doing their business, solve their own problems, sign up new clients, source their own funding. and grow the capital base in that way. And I think the balance is a consequence of that.
Yeah, I think it's far less risky and far higher return generating for our underlying businesses to expand either via brand extension, like Isocast is now with a beauty therapy and skincare products, or like Safari Outdoor is opening up new shops. So we think that's a far less risky way of growing than us sitting here trying to get involved with a new business, trying to understand a new business, trying to build relationships with the management of a new business. So we prefer much rather that our business grow. And if one of them happens to grow so fast it becomes 50% of the portfolio, well done to them. We can only hope another one does the same in the next few years as well.
Yeah, it's like Warren and Apple. It's grown to be a big size of Berkshire now without him having to do too much to it. Exactly. It's maybe a good colory to what you guys are saying there. Then I just wanted to, when you mentioned Safari and Outdoor and OIH more broadly, since it is the biggest asset, let's maybe focus on that for a second. OIH, you know the 2% shareholding that changed hands that you weren't involved in. Not picking up that 2%, was that just because, as similar to some of the other ones, there's no cash at the center, so it wasn't available to take it up, or was the price that the shareholder paid, not kind of to your liking, or you weren't willing to stretch that far? Maybe just a comment on that 2%.
Yeah. Mark, since the first day we have been invested in OIH, every time there was a proposed transaction, we have suggested and the companies followed through, and OIH had bought back those shares religiously every single time. This was the first time where the company, because that's the order, OIH, the company always have the first option to buy back, and if they don't, then any other shareholder. For two reasons. The one is Astoria doesn't have the cash, and the second one is the shareholder that bought the shares come with more than just a check. It's someone with experience in the industry that is valuable, and it will enhance the value of the company. So for us, it was a prerogative to ensure that we do get the specific shareholder in as an owner of the business with a vested interest. So it was more than just a check, and that was the reason we didn't get involved.
Okay. I think I might just add that our original investment in Safari Outdoor Investment Holdings was 10% in about 10 years ago. And we've gone up to 40% mainly via the company buying back its own shares. And as Jan says, it's the first time the company didn't buy back its own shares because the new shareholder comes with a lot of value add.
Okay. And then on the Safari and Outdoor, the last time we were on here, we were talking about the smaller concept store rather than the big Safari and Outdoor. And I think you noted in your presentation that it's, that kind of concept is proven. Maybe just talk through, what are the next steps now that these, smaller outlets are now in place, and what that can do for the growth of the Safari and Outdoor brand across South Africa.
Look, I think the decision is either you have to have a large enough number of these small stores, or they won't make a difference. So ultimately, in the end, every 10 million or 20 million in capital that gets invested in a store, as long as it makes the right return on capital, the overall pot grows at the right size. But for the OIH management team to dedicate an entire management team and structure to a whole new leg of the business, you need to get that big enough. So obviously the natural way is you need to have the right locations, and the team has for years been working on finding the right geographic area, and then inside of that area it is very important to get the store in the right place. And the formula for OIH or for Safari specifically is you need to be outside of a town center in a specific area which is easily accessible to people from various areas, so nice and close to a highway. It has to have lots of outside parking, and it can't be in a shopping mall. It's just the nature of people that come and attend a Safari and Outdoor. It's very uncomfortable to walk through a shopping mall with the typical products you buy, and with a gun and some ammunition and so on. So it needs to be located in the right way. So that's available. Not many of the the geographic locations are available. So the team's waiting for the right stores to open up, and then they will use that and roll it out as and when they come through. But I think ultimately the addition of a number of smaller stores, that's not the saving grace to try and replicate the growth of this business that's happened over the last 10 years. It's nice to be able to do that and to get the products close to some more customers, but opening up that won't grow the business significantly.
I think what is more important at Safari Outdoor specifically is again the brand extensions they're building into the business through clothing, through outdoor equipment and those sort of things. And a lot of this stuff is being built under their own brand. In other words, there's not only growth in the extension of the business, but there's also margin growth because they are selling, they're creating and selling their own brand. So I think that's a much more exciting part of the business. And for anyone who has not been in a Safari Outdoor shop yet, I would urge you to go. It is a fantastic shopping experience. You will not walk out of there without having bought something. There's something for everyone there. It's not only rifles. That's not such a big part of the business.
Okay, yeah. So the Safari, a bit moving more a vertically integrated model there. And then just on capacity and growth, maybe if we look at the Isaac Carson's business for a second, they've got the skincare range now, which is again another brand extension, kind of a common theme through all these businesses. But can I throw out, is a possible third campus, somewhere in the mix of growth options for Isaac Carson's? If you take, they're at two different ends of the country, Stellenbosch and Pretoria, but that still leaves a lot of scope for places like, Cape Town, Joburg itself, Durban potentially. Is that something that's being considered by you guys or and the management team at Isaac?
Yeah, Mark, a third campus is one of the options, and it's definitely in our capital allocation framework. It is one of the options. We know exactly where the campus needs to go if and when we want to open it. But before that, the team first need to do some work in getting technology involved to get more students serviced out of the existing physical infrastructure. That's a much higher return on capital endeavor. So that's where they're focusing. We are investing in technology to be able to have more students come through that. The bit that we're unsure of is at the moment there's about just under 200 students that leave ISA in any 1 year. We're not sure that this specific market can take double that amount of practitioners. So it's not clear to us. So it's easier to test and have more students use the same facilities than set up an entire new facility. And these facilities take 7 to 10 years to fill up. So to go and build all the infrastructure, and then you probably lose money for the first 7 years and only start making money after that. We're first pursuing technology to improve the current efficiencies. And on top of that, the other thing is it takes a lot of energy to build a new business like the skincare range. The economics of that range is just very different, and it's a wonderful combination to what we do already. We think the skincare range on its own can become as big, if not bigger, than the school. So if we get those two things right, if ISA's management team gets more students on the same campuses, and if they can grow the skincare range to rival the school, that's a fantastic outcome in the next couple of years.
Now, I'll take a couple of questions that have come through now. They're on, let's say, return on equity, return on invested capital, whichever you want to take or measure you guys might look at. But maybe one of, what is kind of your goal at the top level for return on invested capital? What are you trying to get from all of these businesses? And then there's a below question on that on, where does the diamond business fit into that kind of return on capital target that you're trying to meet over let's say over a full business cycle?
So I would say that our hurdle rate for investing that which we communicate with our business is around 20% return on equity, which we think is doable for all of these businesses, including the diamond mining business. The diamond mining business is the most cyclical of our businesses, but when it goes well, it goes very, very well. And right now it's going poorly, and they're still profitable. So we're actually quite proud of the management team there, what they've been able to do in terms of adjusting the cost base to market situation, and keep those businesses profitable, where very few other diamond mining businesses in the world are profitable at these diamond prices. And diamond prices are now starting to pick up. So let's see what happens in the next cycle. But we know in the previous cycle, which ended about a year ago, 18 months ago, these businesses are massively profitable. And if you worked out the return on equity, it was in triple-digit numbers, at that point. But it's a cyclical business. So over time, a very profitable business, dollar cash generating business. But all our businesses, we know are set for quite high double-digit returns on equity or invested capital.
I want to add to two things, Piet, on the diamond mining side. So if you look at Viljoen at the moment, we value that mine for 3 years of mining.
Yeah.
So last year, we had said the mine had 5 years of life left, and then you mine one of the 5, so it's down to 4 years. And because diamond prices have come off, there's certain parts of the resource that you can't access anymore. It's too expensive. So literally in a space of 1 year, we've chopped off 40% of the life of the mine. Those cash flows are discounted at, and I think it's disclosed close to 30% in dollar terms, and then we add another 30% discount to that on top. So if the mine just operates normally, that cash comes back to the holding company through those discounts, and that's where the returns of that come through. The old Transex business is now a small part of the business because it has returned cash to us, which we have used to purchase the marine diamond business. So although old Transex, so to speak, the land-based business is reducing, and eventually one day a mine does wind up, it does go to zero, but in the process you collect cash, and we can use it to buy other assets in there. And so I think on those, that's how we think about the return on capital for those businesses.
Yeah, as I said, you can't look at one particular year. It's through the cycle, it has to be hitting the hurdle. Just another question on, if we stick with diamonds for a second, it's a good segue into all the talk on synthetic diamonds, their impact on the broader traditional diamond market with younger consumers, whether they're from a cost perspective, from an ethical perspective. What are you guys hearing within the industry? Because obviously you're very close to it. I'm sure you cross competitors and other players, buyers, jewelers, the whole kind of value chain at some stages over a year or so. What is the kind of general feeling of where synthetic diamonds are going to find their place in this market, and then the impact thereof on the traditional diamond market?
So there is a place for synthetic diamonds, or lab-grown diamonds as it's called. There is a place for costume jewelry, and there always has been a place for costume jewelry in the wardrobe of people who like those sort of things. But there's always will be a place for actual, real, natural diamonds as well. And in fact, there is a body of thought which says the natural diamond prices will go higher than they have in the past because of the desirability of those diamonds relative to lab grown. So that's one aspect. In terms of the ethics of it, I'm not sure. I think that is a bit of a fad way of thinking about it. The amount of energy it takes to produce a lab-grown diamond is massive, and a lot of those diamonds are being made in places like China, which is mainly coal-fired energy. So you are basically wearing a piece of carbon emission on your finger if you wear a lab-grown diamond. So that whole ethical thing is, I think that's a diversion. Costume jewelry, there'll always be a place for costume jewelry. I think lab-grown diamonds have carved out a niche for themselves in that part of the market. They've taken away a portion of the bottom end of the diamond market, but I think it's sort of stabilized now, and we can already see diamond prices are starting to pick up a little bit right now. So I think that's where we stand at the moment. That's what we see.
Yeah, we see the beers result out earlier this week, or the back end of last week, and they were commenting on the pickup in prices compared to last year. So the cycle goes again, as they say. I just want to touch on the discount, because you did also touch on in your presentation in term. You've said the buyback is the last kind of option for controlling the discount. Any other strategies under consideration? Whether that's a discount control mechanism, a tender offer to people who are wanting to get out but can't get out at NAV, or don't want to get out below a NAV and are just like kind of hanging there doing nothing.
Mark, I think we've been clear about this from the start, as we focus on growing the NAV over time. If on the day Astoria listed, it traded at a 40% discount, and today it's a similar discount. So you got return of your shareholding in line with the growth of the net asset value, which was quite a decent return over that period. I think both Piet and I see the discount as the market's reflection on our abilities. So we think over time, if we keep on doing the right things, that the discount will close. It'll probably never go away, and we've been around long enough to know through the cycle, investment companies sometimes trade at a premium. We don't think it will for long periods of time, but it happens from time to time, especially when there's a story around the stuff. So we try not fall into the story trap. We think if we compound the net asset value at a high enough rate over time, the size of the business will get big enough, there will be enough interest, and liquidity will come there. So there's no specific active mechanism from the board or the investment manager's side to try and actively reduce the discount. What's the consequence? Well, as long as the thing trades at a massive discount, we can't do any transactions with paper, except if we find a transaction like Piet where it made sense for both parties to do that. But most of the time, it means we will continue to compound the net asset value over time. If it trades closer to the net asset value, then it might give us an opportunity to do other transactions where we use more than just cash to do a transaction. And we accept that that's the limitation that come from it. So when our shareholders get to the point where they say, guys, you've done a good enough job that we'll accord you a smaller discount, then we'll do it that way. But we certainly don't want to use the company's own money to manage the discount. We don't think that's the right way to go about that.
No, the market needs to manage the discount. We will invest in companies' money as best we can. And in the meantime, we can carry on increasing our stake in the business at a favorable price, which we are doing over time. So that suits us too. So we'll leave the discount up to the market. We'll invest the capital that we have. And one day, maybe the market will allow us, if we produce good results in line with what we've been doing over the past 3 or 4 years, if we continue to do that, the market might allow us at that point to invest more capital. Let's see.
Okay. Piet, Jan, thanks very much for your time again today. I see Marlies after popping back in here. She's trying to hurry me up to finish up this Q&A. So I'll hand back over to Marlies to wrap up today's session.
Thank you, Mark. Thank you to everyone who participated in Unlock the Stock session today, and a special thank you to Jan and Piet for once again making the time to support this investor platform and engage with investors. We hope you've enjoyed this event, and if you would like to listen to it again, it will be on the Unlock the Stock YouTube channel soon. We encourage you to subscribe to the channel for all our latest videos. Please join us for our next session of Unlock the Stock on Thursday, 9 May, where we will be featuring CNS. Goodbye.